Canada's inflation report beat expectations, but for households already stretched thin, this wasn't exactly relief. Prices still rose from March, and this was the first CPI print without the carbon tax base effects. Canadian inflation came in at 2.8% year over year in April and was up 0.4% compared to March. What makes this print interesting is that April is the first month where the year over year comparison no longer includes the base effects from the carbon tax pushing prices higher since the carbon tax was removed on April 1st, 2025. Even with that, energy was still a major driver. Gasoline prices were up 28.6% year over year and almost 9% month over month, while energy overall was up 19.2%. Food inflation was up 3.5% year over year, but actually declined slightly compared to March. Services were also fairly tame, up only 1.7% year over year, while the core measures continued to move lower. CPI median is now at 2.1% and CPI trim is at 2%. So the headline number is still above target, but when you look at the underlying trend, core inflation continues to move in the right direction. The other big macro story is bond yield. The US 10-year bond yield is approaching 4.7%, while the Canada 5-year yield is around 3.35. Both are near their highest levels in roughly 2 years. In the US, the markets appear to be pricing in stickier inflation risks, fewer rate cuts, and more concern around debt, deficits, and bond issuance. One way to frame that is through the term premium, which is the extra yield investors demand to hold longer-term bonds instead of simply rolling over short-term debt. In Canada, the 5-year yield matters because it plays a big role in fixed mortgage rates. If it stays elevated, it puts more pressure on homeowners renewing or refinancing mortgages, leaves households with less disposable income, and can eventually weigh on the broader economy.
On the company side, Constellation Software had a strong quarter. Revenue was up 20%, free cash flow increased 43%, and operating cash flow was up 8.5%. The key segment remains maintenance and recurring revenue, which makes up roughly 78% of the business. Excluding foreign exchange, that segment has now posted 2 straight quarters of 9% organic growth, which is the strongest level we've seen in years. The bigger story might be capital deployment. Constellation appears to have deployed around $800 million during the quarter and roughly $1.6 billion over the last 4 months. If that pace continues, they could be tracking towards a record year for acquisitions. But the playbook is shifting. Constellation is now so large that small vertical market software tuck-ins don't really move the needle the way they used to. That helps explain why the company is increasingly looking at larger public market opportunities through its PEMS strategy, and the AI concern is still hanging over the stock. Management continues to say they're not seeing real disruption, and customers are coming to Constellation with AI requests rather than replacing them. But the market still seems unwilling to fully ignore the longer-term disruption risk in software.
The engineering firm AtkinsRéalis, formerly known as SNC-Lavalin, also had a strong quarter. Revenue increased 18% to around $3 billion. Net income was up 40%, and nuclear revenue increased 37%. That nuclear business is becoming a bigger part of the story because of rising demand for reliable power, especially with AI and data centers consuming more electricity. AtkinsRéalis owns CANDU Energy and is the sole license holder for CANDU Nuclear Technology. CANDU is a strategic Canadian nuclear platform. It uses natural uranium instead of enriched uranium, can be refueled while operating, and could be attractive to countries looking to expand nuclear power while reducing their dependence on enriched fuel supply chains. There are drawbacks compared to other nuclear technologies, but it remains a key differentiator for AtkinsRéalis. The company also announced a partnership with NVIDIA around nuclear-powered AI factories, kept its full-year guidance unchanged, and continues to benefit from a stronger balance sheet after years of debt reduction.
Canadian Tire's quarter looks solid compared to expectations, but this is still a mature, low-growth retailer. Revenue increased 3.3% year over year, while normalized earnings were only up 1%. Comparable sales were mixed. The Canadian Tire banner declined 2.3%, while SportCheck was up 3.3% and Marks was up 1.2%. The issue is that the Canadian Tire banner is still the core of the business and represents around 2/3 of revenue. So weakness there dragged company-wide comparables lower. The financial segment is also worth watching. Revenue increased, but delinquencies continue to rise. Charge-offs came in around 7.2%, which is down from peak levels in 2024, but still well above pre-pandemic levels. So Canadian Tire may look inexpensive, but it also faces a tough mix of slow growth, consumer credit pressure, tariff uncertainty, and heavy Canadian exposure.
Applied Materials is another company tied directly to the AI infrastructure build out. Applied Materials sells the specialized equipment chipmaker used to build semiconductors layer by layer, especially in deposition, e-tech, materials engineering, inspection, and advanced packaging. The simple difference versus ASML is that ASML dominates lithography, the machines that print chip patterns, while Applied Material provides many of the other tools needed to add, remove, modify, and measure materials on the wafer. Its customers include major chip makers like TSMC, Samsung, Intel, Micron, and SK Hynix. This is very much an AI picks and shovel business. Revenue was up 11% year over year. Earnings were up 20%. And the company said roughly 80% of its growth is tied to AI spending. They also expect their semiconductor business to grow by about 30% this year.
And finally, Finning had a record quarter. Finning and Toromont are both Caterpillar dealers, but they do operate in different regions. Toromont is more focused in Eastern Canada, while Finning has more exposure to Western Canada, mining, energy. They also have exposure to South America and the UK and Ireland. That makes Finning more cyclical, but right now that cyclicality is working out in its favor. Revenue was up 2.1%, earnings were up 7.4%, and the backlog reached $3.8 billion, which is almost double 2023 levels. Canada was the standout region with revenue up 14.4%, new equipment up 23%, and rentals up 20%. Management said backlog growth is being fueled by oil sands and coal, and they also are starting to talk about potential demand from data center buildouts in Alberta. Finning also increased its dividend for the 25th consecutive year. It still trades cheaper than Toromont across most metrics, but that discount reflects its greater cyclical exposure.
So overall, we're seeing a market shaped by a few major themes. Rising costs fueled by higher energy prices, bond yields that are moving higher again, AI infrastructure driving demand across nuclear and semiconductors, and Canadian consumers still facing pressure from rates and debt. If you'd like a deeper dive into these topics, listen to our latest Thursday episode of the Canadian Investor Podcast on your favorite podcast player or at tcipodcast.com.